Today, let's get into the topic of life insurance and breaking it down a little bit for you. So, grab a pen and paper and let's just start writing this down. Right. So, first of all, life insurance is an insurance policy on your life should you pass away, and that money would go tax free to your beneficiaries. So, that's the first thing. Now, let's take a look at the three different life policies that are pretty popular. Okay, there's other policies that are there, but we'll just make this a simple breakdown. On the top left of your paper, write the word permanent term. Okay, term. The term policy, and in the middle, write the word ROP, which stands for return of premium. And on the top right of your paper, write the word permanent. Okay, so go back to the left side of your piece of paper, and under term, we're going to list some characteristics of a term policy. Number one, it's for a specified length of time. So some quick examples: a 10-year term, a 20-year term, or a 30-year term. That's the length of time. Now, another uh, thing regarding a term, so you can remember how it actually works, is it's kind of like when you lease a car. Okay, you're leasing a car for a specified period of time. The payments are going to be lower, like they are on a term. But once the lease is over or once the term is over, then so is the policy. Okay, so for example, you have a 20-year term at $100,000 in terms of your death benefit. And let's say you're paying $100 a month. That you'd pay the $100 a month for your $100,000 life policy, and after 20 years, then it's over. It's done. That is the term, and that's the term policy in a nutshell. Now let's go over to ROP, or return of premium. What is that? Okay, so an ROP, essentially it is a term policy, but it's a term policy where it returns all of your premium if you happen to survive the term that you had just purchased. So here's what I mean. So let's say you got a 20-year return of premium and you bought it January 1st, 2025, and you make it all the way through January 1st, 2045. At that time, your term policy is ended, your return of premium term policy is ended, and every single cent that you put in now comes back to you. So say for example, let's just use $100 again. These numbers aren't specific to you. It just makes it very easy to calculate. You spent $100 times, 20, 240 months. So that's 20 years times, um, that $100, 240 months would be 24,000. You'd get all $24,000 back. So it does cost you a little bit more because you're paying for that security, but you know what? Your money came back to you. And for most people, they will survive their term policies. Um, and so they'll get for most of the time, they will get their money back. If they don't get their money back, that means that they have passed away and their beneficiaries have gotten a tax-free benefit that's actually worth more than the money that they've actually put in. So maybe that policy, instead of 100,000, is going to be like $70,000. Okay, but you're either way, you're not at a loss, and the money is going to be either given to your beneficiaries in the term of a tax-free death benefit at 70,000, or you've gotten all 24,000 back. Okay. Now, that's also kind of related to, let's just say, money in a checking account or mattress money, because that money there is, not earning any interest. But then again, it's there, and you'll get that in return if one day you live beyond the term of your return of premium policy. Okay, so now as we go to the right of your page, we're going to go to a permanent policy. And a permanent policy is just exactly what it is. It's permanent. It'll be there for the rest of your life. There's a couple of different permanent policies that are out there, whole and universal. For simplicity, we'll stay with whole life. Whole life, you're just paying that same premium over um, the lifetime or your lifetime, and then at a particular point, the policy will pay out. So now let's take that same $100 premium. Um, the whole life is more expensive because you're paying for the guarantees that the policy will be there for the rest of your life. So let's say you were paying $100 a month, and that policy death benefit initially is $35,000 hypothetically. So you start at age, let's just say 40, and now you're at age 60. You're still paying that policy for $100. But unlike the term, unlike the return of premium, okay, there's a couple things here. Number one, your policy will continue. And then the other thing that's happening into your policy, which is, by the way, similar to the house, is that you are getting what's called cash value. In a home, when the home appreciates, it's called equity. In life insurance, as the money builds into your policy, it's called cash value. Uh, Now, let's say 5 years goes by, it's 25 years later, you're still paying the same premium of $100, but your cash value now, maybe your cash value is at $30,000, and maybe your death benefit now is sitting at $52,000 or $50,000. So it keeps growing. So you are paying for certain guarantees, and those guarantees are that the policy is going to be with you up until the time that you pass away, and that you do have access to the cash value. Because with the cash value, you can basically do whatever you want with it. You could, if you, let's just say, ran into, God forbid, a midlife crisis or an emergency, you can take money that's in your cash value. You can either borrow from that money, okay, or take some dividends, whichever you choose. Of course, see your life insurance expert or agent or company, and they can break this down for you. And if you needed that money, you can, spend it on whatever you want to, whether it's a vacation, whether it's an emergency bill that came up, whether you wanted to buy a car and not have to show that on your credit report, or not have to finance it or actually qualify for it. You actually have money inside of your cash value permanent life insurance policy, which you can pull from. Now, if you were to borrow some money from your cash value whole life policy, would you have to pay it back? In some companies, you do not. So if you don't pay it back, what ends up happening is that the money that you borrow accumulates interest. And if you were to pass on, let's just say 5 years later, then now if your death benefit is $52,000, and let's say you borrowed 5,000 5 years ago, didn't pay yourself back on it, and that accumulated some interest there. Let's say now maybe that amount total, inclusive of interest, is $5,500. They would simply take the 52,000, which is the value of your death benefit of your life insurance policy, subtract out the 5,500, and now your beneficiaries are paid the difference. Okay, so that would simply be it. So they would be paid the difference of 52,000 minus the 5,500, which would be 46,500, and that goes tax free to the beneficiary. So those are some of the reasons that you might want to consider a permanent policy, because it gives you that benefit of flexibility. It gives you that peace of mind knowing that there's always going to be a policy that is there for you that you don't have to worry about. Because unlike the term policy or the return of premium, once those things are over, then you have to requalify for another life policy. At that point, when you requalify, It's going to cost you more because you're older and you're closer to the mortality table of death. Insurance is all about risks, so it's going to cost you more. And then the other thing along with that that you can't account for is how's your health now at that time? Have you developed a disease? Have you had any physical ailments? Have you seen the doctor for some things that have occurred? Maybe you've had a heart attack or a stroke, God forbid, but those things will appear on your medical record, which could make it more costly for you to have a life insurance policy, or maybe in some cases disqualify you. So, with that being said, if you're curious about life insurance, it's better to have a conversation earlier where you would have more options, where the cost would be less, and you could make a better financial decision and a better decision overall for you and your family than to wait later on. Because we're here one time in life, and if you don't pick the right life policy or you don't have a life policy, then this can, not only burden your family because they're already in some type of grief, but it can cause some undue stress or unnecessary stress. So, with that being said, thank you for tuning in, and we'll talk to you again soon.